Welcome back to the Deep Dive. Today, we are really digging into Vail Resorts, or MTN, right after their fiscal Q1 2026 earnings call.
And this was a big one. The call happened December 10th, after hours. And look, Q1 is always the quiet quarter for operations.
Right, the resorts aren't really open yet in North America.
Exactly. So this call wasn't about what happened, it was all about the future. It was a high-stakes look at their strategy heading into the absolute core of their business, the winter season.
And the market reaction, that told the whole story, didn't it? The stock rallied pretty hard afterwards.
It really did.
Which is fascinating because on the surface, the numbers were, a bit mixed. That enthusiasm from investors tells you they were looking right past the Q1 results and buying into the forward-looking plan.
And that's what we need to unpack.
Okay, let's do it. So just for a quick snapshot, this is for the first quarter, ending October 31st. The GAAP EPS was a loss of $5.20.
Which, to be fair, was actually a slight beat. Consensus was looking for a loss of about $5.23.
True, but then you look at revenue. It came in at $271 million. That's up 4% year over year, which is good, but it did just miss the consensus target.
And the net loss widened a little bit to about $187 million. So you hear all that and you think, why the rally?
Exactly. Why the excitement?
Well, you peel back one layer and you see the resort reported EBITDA loss was flat year over year. That showed some decent cost control. But the real story, it was all in the management tone.
What do they say?
They basically said everything was, and I'm quoting here, in line with our expectations and that they were seeing encouraging early momentum.
So it was a confidence play. And the biggest piece of that had to be reaffirming the full year guidance.
That was the mic drop. They held the line completely. They're still guiding to net income of between $201 and $276 million for fiscal 26.
By sticking to that number, despite some of the choppiness we're about to talk about, they're basically telling the market, we have a plan. Don't worry about the noise.
Exactly. We know how we're going to get there.
Okay, so that noise, that brings us to the main event of the call, which was pass sales. The data through December 5th showed this real divergence.
A huge divergence.
So on one hand, North American pass units, the number of passes sold, were actually down by about 2% year over year.
Which is the headline that makes you nervous.
Right. But then North American pass sales dollars, they were up by about 3%.
And there's the whole story in two numbers. The pricing power is there. How do you get there? It was driven by a pretty significant price hike, about 7% on average.
Okay, but I have to push back on that a little bit. A 2% drop in the actual number of people buying passes, especially when they said that weakness was in local drive-to markets like Colorado and Utah.
The core markets.
The core, most reliable markets. Isn't that a red flag? Are you trading long-term loyalty from your bread-and-butter local skiers for a short-term bump in revenue?
It's a fair question, and it's the absolute tightrope they're walking. But management sees this as a strategic trade-off. You have to remember, the total number of committed guests is still huge. We're talking 2.3 million people.
And that's the $1 billion in advance revenue.
That's the billion-dollar floor. It accounts for almost 75% of all their skier visits for the entire year before the season even really starts. That stability, it gives them room to experiment.
So their answer to that volume wobble isn't to cut past prices. It's to attack the problem from a different angle with this new playbook.
Exactly. They're going after the person who didn't buy a pass. They're focusing on the lift ticket funnel.
And they're getting more surgical with marketing to do it.
Very surgical. They talked about shifting spend into paid media, social influencers, and it worked. They said pass revenue growth went from just plus 1% before Labor Day to plus 6% after Labor Day.
So they can really turn the dials when they need to.
They can. But the real innovation is in the new products. They're treating every single lift ticket sale as a lead for next year's Epic Pass.
Okay, break those down for us. The first one was the Epic Friends tickets.
Right. So if you're a pass holder, you can get your friends or family a 50% discount on a lift ticket. But here's the kicker. The amount your friend pays for that discounted ticket, they can apply the full cost toward buying their own Epic Pass for next season.
Wow. So they're literally weaponizing their most loyal customers to act as a sales force.
It's a subsidized customer acquisition program. And then the second product is even more aggressive.
The advanced discount offering.
This is a direct shot at the person who just shows up at the window to buy a ticket.
Yeah.
They're offering a 30% discount off that window price if you're willing to commit a month in advance.
That's a huge discount. That could be over $100 per ticket.
It is. And again, up to $175 of what you pay can be applied to next year's pass. They are actively trying to kill the last-minute full-price ticket sale and convert that person into a long-term pass holder.
And it makes sense. They just hired a new chief revenue officer, Celeste Burgon, who came from Lululemon. That's a very different digitally native retail background.
Oh, absolutely. That's not a coincidence. This whole strategy requires a deep understanding of e-commerce, personalization, and agile pricing. That's the Lululemon playbook.
So if we sum it up, they're fine with slightly fewer pass units right now because they believe this new strategy will grow lift ticket visitation this year and convert a chunk of those people into pass holders next year.
That's the bet. They're using their financial stability to wage a very smart war for the marginal customer.
Okay, let's pivot from sales to the actual operations and capital side of things. They're building a margin backstop, it sounds like.
A pretty significant one. They have this resource efficiency transformation plan. It's expected to deliver about $38 million in savings this fiscal year alone.
$38 million. Is that coming from layoffs, or is it more about technology and efficiency?
It's mostly optimization. They're aiming for over $100 million in annualized savings by 2027. Think about it. They're consolidating vendors across dozens of resorts. They're optimizing their cloud infrastructure. It's about using their scale to get smarter and leaner.
And that protects the bottom line if, the snow doesn't fall or the economy gets rocky.
It's the ultimate safety net. But they're not just cutting costs. They are spending a ton of money.
A ton. The capital plan for calendar year 2026 is huge. What was the number?
Between $234 and $239 million. And it's all laser focused on guest experience.
So where's that cash actually going?
A lot of it is going into lifts. They're replacing the old cabriolet at Park City with a new 10-person gondola. That's a direct attack on lift lines, which is a major complaint.
A huge driver of guest satisfaction scores, I'd imagine.
For sure. They're also upgrading lifts at Whistler and Seven Springs. It's all about getting more people up the mountain faster.
And what about that investment in remote avalanche control? That sounds more like a safety thing.
It is, but it's also a guest experience thing, because remote systems mean they can get terrain open much faster and more predictably after a storm.
Okay.
Yeah.
So guests get access to the best snow sooner.
Precisely. And they're also investing in dining, which frankly needed it post-COVID, and a lot in technology.
Like in the app?
Heavy investment in the My Epic app. They're adding things like in-app commerce, Apple Pay, Google Pay, basically removing every possible point of friction to get you to spend money more easily.
Let's quickly touch on the balance sheet, just for context. Any red flags there for investors?
Not really. Net debt is about $2.6 billion, which is a manageable 3 times EBITDA. And importantly, they said they have no problem dealing with the $525 million in convertible notes that are maturing on January 1st. Liquidity is not a concern.
So even with the big macro risks, weird weather patterns, questions about discretionary spending, they feel solid.
Very solid. And that brings us back to the main signal from the call, holding that full year guidance, even with soft pass units and a slow snow start in the Rockies. That showed incredible conviction. The market heard that loud and clear.
Which brings us to our next segment. And just a reminder for everyone listening, this is not financial advice. We're just exploring ideas based on what we've heard.
This is our outrageous but plausible trade. And based on this call, I think the trade is a structural market share play. You go long NTN and you short a basket of the smaller local ski operators, specifically in those drive-to markets they flagged as being weak, like Colorado and Utah.
Interesting. So you're betting on Vail, but you're also betting against their direct competitors. Why that structure?
Well, it's a two-part bet. The long on MTN is your hedge. You're betting on their stability. That billion-dollar pass revenue floor and their reaffirmed guidance protects you from, say, a terrible snow year.
Okay, so that's the defensive part. What's the offensive part?
The offensive part, the short on the local guys, is a bet that Vail's technology and pricing strategy is about to aggressively steal customers. That new 30% advanced discount ticket, that's aimed squarely at the person who might have otherwise gone to a smaller, independent mountain.
So you're saying a smaller resort simply can't compete with that kind of pricing or with the tech investment Vail is making.
They just can't. They don't have a $234 million capital budget to build a slick app with Apple Pay and faster gondolas. If Vail succeeds in converting even 1 or 2% more of those lift ticket buyers into next year's Epic Pass holders,
then the customer base for those smaller mountains gets smaller and more volatile every single year.
Exactly. It becomes a death by 1,000 cuts. This trade is a bet on that growing technological and financial gap between Vail and everyone else.
That is a really interesting way to frame it. So let's do a quick recap for everyone. Vail held its guidance. They're showing that their new marketing and pricing playbook is working, and they're pouring a ton of capital into digital and on-mountain upgrades.
The focus has clearly shifted. It's not just about selling more passes anymore. It's about owning the entire customer journey, starting with that very first lift ticket purchase.
So the final thought we should leave everyone with.
I think it's this. Vail is using the rock-solid stability of its pass program to wage a targeted high-tech war on the traditional high-margin lift ticket sale. The question isn't if this will grow their business, but how quickly the smaller regional players can even begin to respond to this new reality.
A fascinating deep dive. Thanks for breaking that all down. And thank you for joining us. We'll see you next time.